Right, hello everybody. My name is Graeme Tennant, CEO of Nottingham Asset Management. And pleased to be here today to tell you a bit about the opportunities that I believe we're seeing in the investment management space in South Africa with regards to crypto assets, and in particular how we can, what we can expect as investors, and potentially, I want to use this as an opportunity to encourage some of the investment managers and asset managers in the room to take the opportunity to embrace crypto assets, because I think that it's obviously got tremendous potential to create better portfolios ultimately for investors in the regulated space. Okay, there we go. All right, so I want to start off with a quote by a very astute asset manager who said, "Exceptional investment returns arise from recognizing an emerging trend which the crowd has chosen to ignore." Right? So I want you to take a second just to ponder that and decide for yourself whether you believe that's true. I think that it definitely has relevance, especially for anyone that was early on the Bitcoin train or the crypto train. If you spotted the trend coming, you've obviously done very well. And that's not just the case for Bitcoin, it's true for all different types of investments. And I'd also argue that you could equally say that exceptional business profits arise from recognizing an emerging trend that the others choose to ignore, right? And here I'm pointing my finger to the investment management industry in South Africa. This is a trend that I believe that we should be looking to adopt and embrace, all right? Because I think there's many benefits to doing so. So maybe I can start by just saying to the audience here as a sample set of the investment public in South Africa. Who of you have sat down with your financial advisor or your wealth manager recently, and they've said to you, "Look, I understand we've got an investment for you, we've got a diversified portfolio, we've got your equities and your bonds and your property and your cash. How about we diversify, a little bit further into crypto assets?" Can you please raise your hand if you've had that conversation recently with your financial advisor? Okay, cool, a couple. Right, and understand I'm talking to the converted here, right? So if anyone in South Africa is having this conversation with their financial advisors, it should be you guys, right? And I saw maybe 3 or 4 hands go up. So I think that's the scenario we're seeing here, where the investment management industry has been, in my view, relatively slow, right, to the party. And if we think that, it was 3 years ago that crypto assets were approved for the first time by the FSCA as a regulated investment class. 3 years is a long time in crypto, at least. And it was 1.5 years ago when the first CASP licenses were delivered. So there's nothing really stopping us from a regulatory point of view to actually put digital assets or crypto assets on the table when we're having discussions about regulated investment management, right? Okay. Sorry, I think I'm one side ahead of you guys. How can I go back? Yes. All right, so let's start there. So let's put up a crypto asset management scorecard. I see my boxes and my ticks have got a little bit out of sync there, but you'll get the picture, right? So let's say we're an asset manager and we're looking at this as crypto assets as a new asset class. And I believe that's how we should be viewing it, right? This is not just a fad. We know that crypto assets are here to stay. And in my view, it belongs as an independent asset class alongside your traditional assets, right? But let's say that we're an asset manager and we're looking at putting a scorecard together for whether we should expand our offering to include crypto asset investments, right, in our suite of offerings, right? So we've already discussed the first one, which is regulation. So there's nothing stopping the players in the asset management industry from embracing crypto from a regulatory point of view, right? Then we're going to look at return enhancement, right? Is there benefit from a returns perspective to add crypto? Is there diversification benefits? What volatility management measures are there, right? Because that's one of the big things that keep people out of it is the volatility. And then lastly, is there actual domestic investor demand and appetite for this asset class? So that's what we're going to go through the rest of the presentation. All right, so let's start with return enhancement. So here I've got 3 of the major crypto assets, all right, in terms of the price performance over the last 5 years. It's a little bit busy. But it's early in the morning, so you guys can see it nice and clearly, I'm sure. All right, so we've got Bitcoin, Ethereum, and XRP, right, as the 3 of the top performing lines, and then we've got the Magnificent 7, right? So if your advisor isn't talking to you about crypto assets, I'm sure they've been talking to you about the tech stocks, the Magnificent Seven, right? The seven companies that are keeping equity markets alive and well and pumping in the US, and obviously giving good returns. So I'm sure they had no problem in telling you this is a good way to allocate your funds. But obviously, yeah, at the same time, I think crypto hasn't had the same type of exposure from that perspective. And then you've got, yeah, okay, so let's just go to the next one. So then you've got just the numbers. The returns of Bitcoin, Ethereum, XRP over the last 5 years compared to NVIDIA. Okay, obviously, NVIDIA shot the lights out. So if you bought NVIDIA 5 years ago, congratulations to you. But you would have had to do really well to pick that one equity out of the entire equity market to keep up with what the top three cryptos have done. And then this is not a section of volatility, but just to highlight, Bitcoin in terms of the volatility of the last 5 years is not an outlier, right? It's not exceptionally more volatile than some of your Magnificent Seven stocks. So volatility itself shouldn't be a reason for you not to include it in a diversified portfolio, right? Okay, so those are just individual assets, but let's look at the asset class as a whole, right? So here we've got in the blue line the crypto market cap, the total. So if you were to 5 years ago just indiscriminately buy equally weighted into all the different crypto assets, right? And this is Bitcoin, Ethereum, Ripple, but this is also Dogecoin and Trump coin and your shitcoin and maybe your one altcoin that went to the moon and the other one that crashed and Luna. The good, bad, and the ugly is in there, right? If you had done that, you would have done exceptionally well, right? You'd be up over 500%. And your other traditional asset classes, so I've just picked on a couple indices. So we've got the S&P 500, which is in red. Your financial advisor will tell you how well the S&P 500 is done. And look, I'm not knocking it, right? Every asset class has its place, right? I just think that crypto is not getting the credit it deserves, right? And the exposure it deserves. But you would have knocked the socks off the S&P over a 5-year period. Had you gone into a commodity index, so that's the orange line, you wouldn't have done much better. So that would be gold and silver and oil and sugar beans and whatever else fits in the commodity basket. If you go into property, all right, investors love property, right? Secure, good rental incomes, all right? If you had gone into the REIT, at least, you would only have done 30% of the last 5 years. And worst of all, unfortunately, into long-dated US Treasuries, all right, this is often the core, this is your safe bet within your portfolio, you would have lost approximately 40% of your capital over a 5-year period. Okay, so, and I think that also points to a shift that we're seeing in the world, right? You've got issues in debt markets. We see gold going up, and it's all the more reason, in my view, that you need further diversification in your portfolio in this day and age, past your 4 major, maybe 5 major asset classes. Okay, so I think we can give that a tick, all right, for return enhancement. I won't ask if anyone argues, but yeah, I believe that it's a pretty strong argument that you're going to get enhanced returns if you've got that exposure. All right, now let's look at diversification benefits. All right, I'm not going to go into detail here, but just almost the first principles. There's great benefit, right, in having uncorrelated assets within your portfolio. So you might say, hey, I've got 7 different stocks in my portfolio. It's a Mag 7. I'm diversified. I've got 7 different shots at performance. Right? That's a misconception, right? You're not diversified because what drives the prices of the Mag 7 is very common, right? They're all going to go up and down together. So what we're looking for here is assets that perform differently at different times, and that gives you a smoother trajectory in your investment experience, and it's called the only free lunch in investing, right? So they say there's no free lunch. Well, diversification is that free lunch. So the question is, does Bitcoin or does crypto assets actually give you that those uncorrelated returns, true diversification in your portfolio? Just quickly, if we look at the squiggle lines there, so if you see asset A and asset B, this is just hypothetical. Those are the 2 top performing assets, right? But you can see just visually looking at them, they're quite correlated. Asset C is the worst performing asset, right? But it's uncorrelated. So it goes up when the others go down. So the best portfolio here is not asset A plus asset B, right? It's not holding Tesla plus Apple, right? It's holding Tesla and maybe gold, which is C, to give you that uncorrelated return. So then if you look at the slide there, The green chart in the second picture is asset A plus C, which you can see is a much smoother return and gives you a very similar return to actually A plus B. Right, so that's just the concept of diversification. All right, and then just from a fundamental perspective, well, we'll look at some data in a sec, but I think it's clear that for everyone, they see something different in some ways to crypto assets, right? And I would argue from a fundamental perspective that crypto assets has characteristics that are truly unique to any other asset class. Is it the new money? Is it the new payment system? Is it the new foundation for real-world assets and Internet of Things? Right? What is this crypto? There's no other asset class that can claim to have so many different potential paths and use cases, right? And I think for that reason, in the same way that the blind person's feeling the elephant, like it's got all these different elements to it. And because of that and its uniqueness, I believe that it's got unique characteristics that are going to give you that uncorrelated return from a fundamental perspective, right? So let's look at some numbers. All right, so if you've got a correlation of 1, okay, that's perfect correlation. So this is the correlation of different asset classes to the S&P 500. So you can see, obviously, the S&P correlation to the S&P is 1, right? It's a perfect correlation. So you can't get higher than that in terms of a correlation score. And then you've got the NASDAQ, which is fairly correlated, as well as international stocks. Even your corporate and high-yield investment bonds are more correlated than Ethereum and Bitcoin and commodities. All right, so the data suggests that there is benefit. Further to that, it's a bit busy, but that shows you like the correlation of different assets in a correlation matrix, and red is highly correlated and green is uncorrelated. So it's only the US dollar index compared to your risk on assets that are typically uncorrelated. Bitcoin is the second column at the bottom, right? And you can see that's mainly yellow, a little bit of orange at the top. But your top score there compared to the NASDAQ is only 0.37. Okay, so again, I think another example of demonstrating its unique diversification benefits. All right, we'll skip through that one. It basically shows the same thing. Okay, so I'm going to argue that we can give the third box a tick. All right, so we're doing well. 3 out of 3. Okay. All right, next one, volatility management. Okay, and for me, this is one of the major oppositions I get when I talk to people in the industry. Is that Bitcoin's risky, crypto's risky. If I put my clients in here, they're not going to be able to stomach the drawdowns. Okay, and I do think that there is some merit to that discussion. Okay, and I think it's important, depending on the investor, depending on their risk appetite, to see, from an asset management perspective, what solutions and what products can we offer that help manage that volatility. All right. So I'm going to show you just 3 product offerings that we're looking to bring to market from Nottingham Road Asset Management, and how we're aiming to manage that volatility and obviously align the different products to the different investor types and risk profiles. All right. So the first one is the Crypto Nova Fund. All right, I'll go into a little bit of detail with each one, but just give you a high level. So this is an algorithmic trading strategy which uses crypto as essentially the bridge between different exchanges to utilize or access those opportunities. All right. So it looks to deploy arbitrage trading across different platforms, different currencies, as well as directional trading. Okay, and it's got limited crypto exposure. All right. Then number 2 is a structured product. What we're aiming to do here is to give the investor capital underpin. All right, so capital protection over a set amount of time, and then limited exposure to the upside of the crypto asset. So we're giving you the diversification benefits, we're giving you the performance enhancement, but we're giving you a floor underneath your investment as a risk management strategy. And then the third one, all right, that's direct exposure into crypto, all right? It's 1 for 1, so you ride the roller coaster, all right? But this is where it's important that you're obviously profiling this, this offering with the correct risk profile, and it's correctly sized, right? So this is the responsibility of your financial advisor to say, right, how do we size this correctly for you? Are you willing to take a long-term investment? Can you go through the ups and downs? Because ultimately, as we've seen, if you stick through the course over a long period of time, you should do better in this asset class than any other asset class out there. All right, I'll flick through these quickly. So this is back to the Nova Fund. So what we're looking to do here is hold 30% of the assets in crypto. And really, the main benefit here is that XRP is the main crypto we use, which is really fast and really cheap to send across different exchanges. We trade across the 3 local exchanges, as in Luno, Valor, Zargo, and then the one international exchange is Kraken. All right, and there you can see a breakdown of the different strategies that we're looking to run. So we've got 35% allocated to arbitrage, 30% into directional, 20 into momentum, and 15 into mean reversion. And we can obviously tweak that, depending on the market conditions and what is performing. So we're aiming to achieve a 15 to 20% annualized return in dollars within this fund. Okay, then the crypto asset structured product. All right, so let's just start here. So what we're aiming to do here is over a 3-year period, we say, right, Mr. Investor, we're going to take 80% of your funds, right, and we're going to buy a bond, all right, and that bond is going to mature at a specific rate. So by the end of the 3 years, you've got 100% of your capital back, all right. So worst case scenario, at the end of the 3-year period, Mr. Investor, here's your money back, all right. So it puts a floor under your investment value. But then with that other 25%, we can be really aggressive, right? So what we do is we buy a derivative instrument, in this case, let's call it a Bitcoin call option, and that gives you leveraged upside to the performance of Bitcoin. All right, leveraged upside for that 25%, but obviously it's a small portion of your portfolio. Okay, so ultimately what we're looking to achieve is a 50% exposure to the price of Bitcoin. All right, so if Bitcoin goes up 100% for the year, you're going to go up 50. If it goes up 50, you're going to go up 25. All right, so you've got half of the potential upside, but remember you've got that floor in your capital over the 3-year investment period. All right, and this, in my view, is a very effective way of managing that risk. All right, so you don't have to, as an investor, stomach a 30% drawdown or a 50% drawdown, right, in your capital, because you've got that capital underpin. And then you can be more aggressive and you can deploy more capital into this strategy than maybe you'd want to deploy directly into the market if it's highly volatile. Okay, and then the last one is the crypto model portfolio. So this is a direct investment into the actual asset. We're looking to invest between 5 and 10 different crypto assets. This is just an example of what the portfolio may look like if we're allocating just to 5. And then at our discretion, as the asset manager, we will say, look, we want to include, I don't know, Cardano, and we want to remove Binance Coin, right, at our discretion. So that's going to give you a professionally managed investment portfolio, fully regulated, to include in your traditional portfolio. And obviously, our expectation is that you're going to benefit from return enhancement and diversification benefits. All right, so we are 4 out of 4. We're doing well. Last one should be easy because we've got our sample set of investors here. So let's measure market demand or investor demand for having crypto as part of your portfolio managed by a regulated investment manager or asset manager. So can you please raise your hands if you would like that to be a service that is on offer to you? Okay, awesome. All right, so that's the easy one. So we can definitely give that another tick. All right, so we're 5 out of 5. So this is my, I guess my message is that we've got an opportunity to recognize this return or this potential emerging trend as an industry. And my message is that as an asset management industry, the opportunity there is to embrace it and obviously deliver better products and services to the investor public in South Africa. All right. Thank you for your time.
You might have some questions, so don't rush off the stage. I want to give you the short answer, but it's not. I'll give you the long answer, right? So it is part of the challenge, right? So it is a bit frustrating because the industry or the regulators obviously said, yes, you can regulate crypto assets, but for example, in the Collective Investment Schemes Act, it doesn't talk about crypto assets. So I'd love to launch a unit trust, but I can't, right? Because it hasn't filtered down to some of the smaller acts. pension funds can't hold it. It's not within Regulation 28. So these are some of the things that are stifling true adoption on that level. But at the same time, the mechanisms are there to create these type of products that I've showed you. And I believe that that's the opportunity, is to bring those products to market through the regulated channels. Make sense? Yeah, so you can look at in common diet partnerships, you can look at endowments, you can look at segregated portfolios. So those are the different structures that we're looking to utilize. Yes? Shout.
Sorry, there's just a few things that I'd like to point out, and that is, like, as an asset class, 2.2 trillion assets under management. And if you look at the volatility index on Bitcoin over the last year, it's had its smoothest volatility tranche over a 10-year map period. So very important is, the volatility drawdown versus some of the Mag 7 are actually moving exponentially more than Tesla, for example, can easily match or even exceed Bitcoin volatility. And sorry, my other question is, in terms of adopting potential alternatives to direct investment, what about treasury options of specific ETFs and or proxy companies that are implementing treasury strategies listed in, for example, on the NASDAQ?
So, sorry, do you just want to make those a question? Then I can answer specifically the question.
Sorry, the question is, as opposed to direct holding, why not use treasury and or ETF equivalents to formalize your structure?
Okay, so I think ETFs have their place, right? And that's going to give you, direct exposure. As an asset manager, that's where I think our expertise can come in terms of managing risk through different product offerings. I don't particularly like the digital asset treasury companies because I think there's additional risk in there. There's potential leverage. I think it's sometimes opaque about how they're actually managing their risk within those structures. So personally, each their own, but I stay very far away from digital asset companies. And I think there's the potential for there to be a pretty large bubble, right, in that. And if you do have a bear market or significant drawdown in crypto over an extended period of time, there's the potential for liquidations, for selling, and I wouldn't want to be exposed to that personally. Yes?
Hi, Graeme. I think what you're saying is very important, so thanks for what you've said today. I think in the traditional financial advisory space, asset management space, what we've seen is definitely a curiosity around the asset class, but there's just it's fear of the unknown. They don't know where to start. It's moving at 1 million miles an hour, always has been, and it's still moving at that pace. How has your firm and the advisors and asset managers in your firm upskilled themselves to be able to offer this asset class to your clients?
So I think that's a great point, right, is education. And obviously, if your financial advisor and your wealth manager is going to give you correct advice and guidance, they have to be educated on the topic themselves. Our masthead, for example, is our compliance officer, and I think that they've, for example, got really good resources. So there's many CPD courses, one can do. So the education is definitely there. But it's about, I guess my issue is not really the financial advisor on the ground. It's actually the leaders, right, within the different companies and the leadership that, through my experience, are not embracing crypto assets. Because I think all that comes in time, right? If your CEO or your CIO says, right, we're embracing crypto, then I think everything leads from there, right? And then you can put the education and the skills courses in place to obviously bring advisors up to standard where they can add value to clients.
Hi, Graeme, can I take a question here at the back?
Yeah, sure.
At the back, JP from Binance. I had the opportunity to spend some time at the Finance Indaba in Sandton Convention Centre last week. So a question that comes up all the time with regards to SMEs is guys sitting on a lot of cash, not wanting to invest in stock or anything like property. So they are looking at reserves, basically using digital assets as a reserve. Maybe it's an opportunity for you, but I think there's a lot of guys especially business owners that have some savvy and they want to look at doing a reserve? I know you talk from a one-on-one basis, but for SMEs, how would you go about setting up that reserve? I don't know if it's out of your comfort zone, that question, but we get a lot of questions about that. Thank you.
Thanks. So we do deal with institutional clients. Yeah, I mean, they've got different needs to your typical investor. Often they've got a shorter term time horizon, right, with regards to their working capital sometimes that they're looking to deploy. But yeah, we do have clients and we do deal with them on a bespoke basis. So yeah, welcome to chat with you afterwards if you want to pick it up further. Yes.
Morning, Graeme. I just have a question with regards to things like inheritance and the movement of the ownership of assets. So I'm thinking, long term, because, it's quite easy, from the first start, if you buy assets, but now in the long run, and I'm sure, at some point we might die. Obviously, you need to move the assets and, maybe assign a beneficiary. Do you guys maybe offer that? Because obviously we don't want a situation whereby, okay, I'm dead, but now what about, the assets that I have? Maybe I might, maybe store it in a self-custody, secure wallet with seed phrase. So obviously I need to keep that secure. But in terms of inheritance, do you provide such services?
Okay, great. I think it's a great question, but I'm going to politely sidestep it because that's not our area of expertise, right? It's in terms of inheritance and estate planning, etc. So there, I would advise you to talk to an expert in that field. How we are looking to position ourselves, obviously, is to take on assets from investors directly, manage those assets, and protect those assets, right? So our security and our counterparties and who we choose is really important. And we're looking to service that individual that doesn't want to have their own hardware wallet necessarily, or doesn't want to worry about should they buy or should they sell, or how they're going to manage their risk. So that's where we're looking to step in and obviously facilitate that. But in terms of actual inheritance planning, estate planning, I suggest you find a professional that's specializing in that area directly. Yes.
Thank you for the presentation, quite enlightening. I'm wondering, as next steps, are you guys, how is it looking if you are thinking about DeFi, decentralized finance, using those assets, borrowing and lending, additional yield, example for staking Solana or Ethereum, something like that? I'm not sure what the legislation looks like, but I'm want to hear your opinion about what you think about that sphere.
So it's not directly what we're currently involved in. We don't deal in the DeFi space at all currently. I think there is definitely an opportunity for collateralized lending, right? Especially, let's say, for, not even wealthy individuals, right? You've got your Bitcoin, you've got your Ethereum, you've got your XRP. You don't want to sell it, right? If you're a long-term holder. And this is a very effective way to also avoid capital gains tax, right? So if you've bought Bitcoin 10 years ago and you've done exceptionally well, you don't want to have that tax event. So why not loan against that Bitcoin, right? And now you can, you have the benefit of spending against it without actually selling the goose that lays the golden egg. So it's not something that we're currently offering explicitly right now, but it is something that we're looking at. And regulation does allow for that practice in our view. Yeah.
Thank you.
Hi, Graeme. Here at the back.
Go for it.
Yeah, I'm curious about day to day. How do you manage your customer accounts? So, actually, if you have a customer that wants to have some of their holdings in Bitcoin, what are the tools you use, like the exchanges? If you actually open the accounts for them, do they do it themselves? Just curious about how exactly it works in the background.
Sure. So look, it is going to be different based on what investment structure we use. So like I've said, we have segregated portfolios, we have in-common partnership structures and potentially endowments. So you would then obviously engage with your exchange or counterparty through that, through the different structure. We've got quite a nice setup with Valor. So we've got a corporate account, we've got sub-accounts, but those are, you can call it almost enshrined sub-accounts. So legally those assets are segregated to that individual, which is really important, right? So in a bankruptcy or liquidation or credit event, those assets don't form part of Nottingham Road's asset management's balance sheet. They belong directly to the clients. So that separation of ownership is really important. And it's a requirement of the FSCA also to be able to show that segregation of funds. So yeah, I think the industry is maturing and has matured, right? In my view, is now in a position that we can responsibly and effectively, as an asset manager, bring these products to market and do it justice, right? But again, I think from the top, if you look at your traditional asset managers, we're not seeing that that innovative thinking, right? We're not seeing them embrace this asset class to the degree that I think is warranted. Yes. Last one.
Is that a question? Or it's a mic here?
Morning, Graeme. What % of our portfolio should be in crypto, and how do you manage the correlations in times of crises?
Okay, so I think that comes down to each individual and your risk profile, right? What are your financial goals? So I think that's the role of the asset manager, your financial advisor, to determine what is correct for you. We typically don't play that role, right? We, the asset manager, we one step back. But and maybe to the previous point, that's where education is really important, right? So that your financial advisor can appropriately advise you around what is responsible and what is effective for your portfolio, given your risk profile. So yeah, I think it's quite a broad answer, but yeah, there are ways obviously to do that, and it's not that unique, right? Because we're doing it for the Mag 7, we're doing it for equities, we're doing it for other volatile assets, right? So there's no reason why the tools are there, to perform the same type of analysis with crypto. It's just a different asset class, and I just think it's a mindset change that the industry needs to embrace. Thanks all. Cheers.
Thank you so much, Graeme. And you indulged us with the question, so thank you very much for that.